This is our Forex blog for July 14th, 2011. And like most days, we really want to buy the strongest pairs versus the weakest. And it's always easier, the odds are higher, the winning trades are usually bigger when all the time frames line up. So really the New Zealand was the only one where the real-time strength was there, the daily, weekly, monthly trend was there. The dollar's weak on all time frames, and so is the euro. And so those three pairs, combined, the euro, selling the euro New Zealand, buying the New Zealand dollar, or some of the highest probability trades when you find real-time momentum that's there. The New Zealand was very strong until about 4. Unfortunately, the euro was also strong during that, and the dollar, was as well. In a perfect world, the dollar would have been weak when the New Zealand was strong, and that would have been a no-brainer to buy. The yen was the weakest one during that time, so let's start by looking at the New Zealand yen. Strong New Zealand, weak yen. Notice a huge move up yesterday, pulls back to the 20-day moving average, which is the major support area, which you can see on your 5-minute chart, and the hourly moving average. We have Fibonacci support area just a little bit underneath there, which always makes it a little safer trade because there's usually massive orders there. I like to draw trend lines coming down off the bar's high. When it gets in here, you might get out of the trade here with a small win, pulls back again and double bottoms at the hourly, breaks out right here, and you can see it goes from 27 all the way up. The trailing stop gets you out up here with almost a 50 pip move on the second wave. Now, most of the other currencies today were pretty choppy, but when the New Zealand was strong from 2 to 3, the euro was also strong from 6 to 7. It was, it was weak, and then from 10 after it was pretty strong. From 10 after, the weakest pair is the euro. The strongest pair is the New Zealand. Fantastic shorts after 10. You can see 10 o'clock right here. Price is underneath the hourly. Frequently when it comes back up and tests the hourly, touches it, can't get above it, it's a pretty safe short. You can see there's a nice little 20 pip drop here. We have a false breakout above the hourly again. Previous day's low is a resistance area, and once it breaks down right here with a trailing stop, we go short again. You always want to draw your fibs on the chart to get a feel for the most likely profit target. Rarely, probably 80% of the time, the market doesn't go below the 1.618 fib target. Let's draw this on here from the high. Notice to the pip, the 1.618 fib target. There's no reason to wait for the trailing stop to get you out. You capture another 20 pips in this instance, or you could wait as it goes sideways right here and the statistical weakness is falling off. Other euro pairs are no longer as weak. Other New Zealand pairs are no longer as strong, so you get out somewhere maybe in the middle up here of these fib targets. Recently, we have a very strong pound. The euro is extremely weak, so trading it after 10 o'clock, you want to sell the very weak euro against a strong pound. And notice the smooth continuous trend. This was above the hourly, so mainly you want to focus on buys. There were some small trades on here, small wins, small losses. You go short once it breaks that trend line. You got about a 10 or 15 pip move here. You short again, and it looks like it still has you short. This is a very nice move, 25 pips down. One of the new tools we're about to release today is our trailing stops that are based on tick charts. These use statistics, like all of our tools do, where if the momentum is up, it keeps you into the trade. Where the momentum is down, it keeps you into the opposite trade. And notice, when the market's chopping around, it has very small and oftentimes break even or a pip or two win, pip or two loss. In right here, out. Let's try to find one that was moving more in the last here's the let me scroll back and find when this was trending. Here's the euro dollar. Let's say the euro dollar's trend is down and you want to just look for sells. Short right here, out. It's 15 pip profit. Very, very ultra tight stop. This is probably the tightest stop you can possibly use. And if you see a little double bottom on the tick chart and you want to go long, It stays with trend as long as all the euro dollar pairs are going up on the tick charts and the dollar pairs are going down. It keeps you in there. Out up here at 85, long right here around 55. That's a 30 pip win. Short right there when it breaks underneath the trailing stop, and you can see out again. Very, very tiny losses, or a pip or two wins, or break evens when there's no momentum. But when there is momentum, it keeps you into the trade. Let's try to find one of the pairs that was most trending over the last few hours. Well, let's look at the euro dollar drop that occurred. Obviously, this isn't a downtrend. It broke the hourly, broke the fib area back at 10. The euro was one of the weaker pairs. So let's bring that back up and look at the euro dollar over the last few hours. This is previous today. And as this drop occurred, remember this is on a 50 tick chart. If you want, you can use this on any time frame tick chart you want. If you want to use 100 tick charts, each bar might be 20 or 30 seconds. If you use a 50 tick chart, some of these bars are only seconds apart from each other. This bar here was 20 seconds. This bar right here, 30-second bar. So the tighter the bar, the smaller the time frame, it is possible that you're going to get some more whipsaws. If you're in one of the weakest currencies, obviously you want to use the fib targets as well. You had this big drop from here earlier, and this is a tool that works live. It doesn't work historically. You have this big drop right here, and usually the fib targets are where the market's going to find support at, and that's where you can usually look for counter trend trades too. So knowing that the fib target's just a few pips underneath you might want to wait and get out of your trade here. And as far as the counter trend trade goes, wait for the market to go to a support level, then cross above the fast trailing stop to go long, and you have a very, very tight 3 to 4 pip stop. Just wanted to preview that in our blog. We went over it in more detail in class today. Currency meter most of the time is going to have you trading these super strong pairs. Weak euro, strong pound for the most part, with the exception of an hour of weakness here. Very strong dollar. Also very strong New Zealand, which is strong on all time frames. The pound, at least the pound, while the weekly monthly trend are down, from 9 o'clock onward, it's been extremely strong, and the daily chart trend is up. So the euro pound, made a lot of sense to sell, and our IntelliTrends trailing stops work on regular time-based charts too, and it tends to keep you into that trade. If you want to hold for more than 5 to 25 pip moves, you might want to use this on a 5 or 10 minute chart. And the new FX IntelliStop tick is for those who want to scalp and have the tiniest losses possible. Let's say you want to buy the low in a currency that's down 150 pips. It's super weak. You're scared to pull the trigger. You don't want to have a 10 or 15 pip stop. You also don't want to trade tiny lots. You want to trade decent sized trades, 3 to 5 or 10 lot full lot trades. $100 a pip. A 5 pip stop versus a 15 pip stop is an extra $1,000 loss if you're wrong. And that's where our FX IntelliStop comes in. If you get into a trade and it shoots up 20 pips, you might use a longer time frame 5 minute bar trailing stop to get you out because you're expecting a 30 or 50 pip move. Also, you can switch between them. Let's say you're up 30 pips and you think the trend's going to end, drop down to the 50 tick chart, and if it shoots up another 15 pips because all the euro pairs, in this case the euro pound, all the euro pairs are going up tick after tick, second after second. Pound pairs are getting weaker versus all the rest of them. That's how our statistical tools work. It'll keep you in there. So as soon as you're thinking about getting out, just hang on until the momentum switches. This is one of the trades that one of our traders was in during our class time. He was short around 41 here, and the trailing stop kept him short, and they got out right here and got right back in, and the trend continued down. It's still in. It's only down another 10 pips, but notice it's already locked in half that that profit. If this is going to go sideways here and then down another 10, 15 pips, you're going to make that versus giving it back to the market.